Prime Big Deal Days is coming October 8th and 9th with exclusive savings just for Prime members. Woohoo! Involuntary deal squeals can happen, like the deal on new running shoes squeal. The deal on a new blender squeal. Or the infamous deal on a new massager squeal. Prime members save big on electronics, fashion, and more this Prime Big Deal Days, October 8th and 9th. Shop early deals now.
Start your electric journey right here, right now with a
and this is all ahead of the Chicago PMI too, by the way. That comes out in less than 4 minutes. So I take this as them fluffing up the market, stopping out any individuals that were short, and then they may elect to take the market down sharply into our objectives here on the day or going into tomorrow. That's kind of like what I internalize. Scout's such a little tiny boxer. Like, she's little, but she snores like a Saint Bernard. Sweetie, but she's, I don't know, she's got an awful snore. We don't care about your dog, ICT. Put a trade on. Sorry, this is union rules. All Furus have to talk about things outside the chart to distract you. Union rules, man. We have to do it all the time. This guy's an asshole. I see it. Look at the Dow. This is garbage. You guys want to trade this one, man? Like this to me. I know some of you are like, oh, this is my thing. This is my thing. You can have your thing. Look at that. It stopped dead on the high. That would annoy me, to be honest with you. If they just dropped it from there, that would absolutely annoy me. But it would mean that we're probably going to have to come up there later on, which would be fine, right? If they're going to take it all the way down to our NASDAQ objective, they're leaving what up here then? Buy side. So coming all the way down to that deep discount on NASDAQ and dropping ES and sympathy with it, this would be where the market would draw to on the upside if it goes down there. Down where? Down there. So looks like we're trying to build in that pseudo bull flag thing. So right away you can see how and why I don't keep all this stuff on my chart, because to me it's absolutely distracting. But I have to have these things framed out for you to understand what I'm looking at. So if I'm holding an opinion around certain key levels, what are they based on? Well, everything I've outlined here. All right, 30 seconds to Chicago PMI number. Ten seconds. We'll see some volatility. This is a medium impact news driver, so it's not red, but it's inside that first 30 minutes opening range, so that can tend to be a little bit more animated than normal. We really should be looking at ES, Michael. See if they run those relative equal highs. No matter what price is doing in this environment, because there's a decoupling between all three averages, that gives me a confidence to sit still. If every average was moving in the same direction, I would feel like they were probably going to take it higher and continuously move higher. But because the Dow had already, like, imagine a canary, a little bird. Okay, coal miners used to have these little bird cages in the coal mine with them, and because they're a smaller little animal, their lung capacity is smaller and they're more susceptible to adverse climate and environmental changes. When oxygen levels would drop to dangerous levels, the coal miners would know that, because the canary would stop chirping and it would be dead. So the Dow was, in my opinion, so far, that's what it looks like, it looks like it was the canary in the coal mine this morning saying that it went down when the other two averages, the NASDAQ and the ES, went up. ES has unfinished business here in the form of buy side. So that's the holdup for anything going short for me. I want to see it go here, disrupt these relative equal highs, and then see how we trade after it does that. And I would like to see it move lower sharply after it goes there.
Craving a weight loss solution that actually performs?
A few clues that might be in play, but we still have to work through the effects of the Chicago PMI. Not that the data itself is moving price. They use these high impact or medium impact news drivers. They use these as smoke screens, basically, is what I'm getting at. Like it's easy to justify on the news, oh yeah, the market had a so-and-so rally to blah, 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 because of the Chicago PMI number. The market's not reacting off of the number. The market's going to go to where it needs to go. In this case, it's going to go to where those stops are. But anyone that doesn't think the way I'm teaching you to look at the market algorithmically for the purposes of taking liquidity, unseating individuals, and taking over their position, or knocking them out of their profitable position to add more to their longer term profitable trade, that's what the market does. And by having that perspective, it in my mind it does give me an advantage versus just looking for a pattern for sake of it appearing in books and people say it works. I've lost money on patterns. But knowing where the liquidity is, the time of day, how this entity cannibalizes other traders that don't realize that it exists. It's like that monster under your bed. It's there. You know it's there, but you're just too afraid to bend down and look underneath it or let your foot dangle off the edge of the bed. So in 2024, you have been getting a clinic on how to avoid adverse market conditions. Markets are moving around, I'm not denying that. But they're moving around in a manner where I can be comfortable not being a part of them because it fits the logic that I'm teaching. What happens when these things are not in place in price? We're active. We're in there trading. We're in there taking setups, and we have low stress. We have no anxiety. We have 100% trust in what we're looking at because we don't have these things plaguing it. A perfect world, a perfect trade setup, all three averages are going to move together. That's Dow theory. That's the only extent of Dow theory that I have. That's it. I want to see the averages confirm. And I didn't learn that part from Dow theory. I learned that from George Engel. So that idea of when S&P is moving higher or lower, because when I first started trading S&P, I would have the NASDAQ, I would have the Dow, I would have a tick chart, I would have a couple other little retail things that are not even important. And I would use the idea of all three of the averages needing to move in the same direction if I'm bullish or bearish. And at that time, I was using floor pivot numbers. And that was my support and resistance, those levels, those numbers. And I didn't understand when I was watching them trade through those levels that there was something else going on. It was going to the liquidity that's beyond that floor number. Just because those numbers are calculated on the previous day's open, high, low, and close, it doesn't mean that it's going to be the low of the day or the high of the day or the session. But liquidity below an old low or old lows can be the low of the day. Liquidity above an old high or relative equal highs can be the high of the day. And the pivot number is just a suggestion of where it might reach for. It's like a draw on liquidity, but it's never ever to be viewed as a terminus level where this is it. It's never going to go beyond that. That's the mistake I found I was making, and I think every other trader that uses floor numbers and pivot numbers, they use them as a panacea. Like nothing's a panacea. Like literally nothing in trading is a panacea. There's no be all end all ends everything. It answers all questions. Because if anything like that existed, number one, I can tell you honestly, I would never teach that, and nobody else would either. So stop looking for it because no one's going to share that with you, and they're never going to sell it either, even if it is an expensive amount of money. Because they could sell things for $5,000 even though it's for free on YouTube. If they believed it was exactly what they try to market it as, they would never sell it. They would just simply use it because that edge would diminish. Well, the reason why I can teach this is because this is the market. It's the lifeblood of markets: time and price and liquidity. If it ain't liquidity, it's inefficiencies, and that's always going to be the game. It's never going to be anything but that. All right, looks like we could make a attempt to get up here. Finally work those levels out. Got 37.5 minutes where Caleb could still find a setup. Let's take a quick look at Dow real quick. Yeah, still ugly. Okay, see what it's doing? It's just hanging around. I like that. I like this. To me, I view this as it's got to look like it's trying to be bullish to allow ES to do its damage on those relative equal highs. That's how I see this. This right here, just it's ugly. It's really, really ugly. That's exactly what I was telling you. It's going to hang around in like this bull flag type formation where people are going to want to see it go higher. They want this to break out to the upside. Retail traders want to buy this. They want to be long in this, especially after seeing all this shit. So by having ES with its unfinished business up here, here's what's happening. Phil's watching my live stream this morning. And he's like, I'm going to fuck with you today, ICT. We're going to sit here and just hammer that. It's okay. It's okay. I'm still going to make money today. I'm still going to make money today. It don't have to be in this stream, bro. But we're waiting for the green light after the buy side's taken here. Mm-hmm. Now, let me ask you a question. If you were, say you went long, okay, say you were long in here, somewhere in this area, or maybe you use this inefficiency here, how would you feel with the way the market is trading right here? Would you feel uncomfortable? Would you feel like you're comfortably going to submit to it eventually break into the upside to get these relative equal highs? And would you expect that to continue if it goes up here and keep moving higher? Or are you trying to just get out and be done with it here? Because admittedly, I would be a little uncomfortable with the amount of time it's spending in here. Because it could very well do what we saw a couple weeks ago, the same thing with NASDAQ. And it would fit the underlying idea about if it's going to drop for NASDAQ to go down to that weekly inefficiency, by them leaving this area up here smooth like that, because it doesn't have to go up there and do that. I just want it to do that, and then that would give me confidence if it starts to break down, then we can take our attention over here for sell side for ES. And then more specifically, what we were looking for NASDAQ, down here. Right there. So while it's up here, retail traders are not thinking anything down here. It's completely outside their radar. They're not even thinking about it. They don't think it's even possible. They're looking for a continuation to the upside. A small little gap here. Now, it's already done. If you look at 2016, 2017, private mentorship, that's my paid mentorship lectures. And there are people literally on Instagram, on YouTube, on Twitter, everywhere trying to sell those same videos for free. They're on my YouTube channel, but they're trying to sell them to you. Don't be a stupid ass. Go to the YouTube channel and taught decoupling in the core content lessons. And the same thing with Forex. So if you're watching Forex or trading Forex, if you're trading like euro dollar or you're trading pound dollar, if you're bullish on pound dollar, you should see in a symmetrical market euro dollar be bullish and dollar be bearish. That's a symmetrical triad. Like you have to have three things in Forex. It's not just a one type thing. Like, can you trade profitably with just watching one pair and nothing else? Yes, if you're a price action trader. But to get a full panoramic view of what price is doing and how it should be viewed as high probability or low probability, in Forex, you want to have a correlated pair, positively correlated, meaning euro dollar is positively correlated to euro dollar. They usually move in sympathy with one another. If one goes up, the other one usually goes up. Not all the time, but generally they do. And if that's occurring, if both are moving up, the dollar index better be moving down. That's a symmetrical market. There are instances where the pound dollar going up, euro dollar going down, and dollar sitting still. And that's going to be a euro pound short because it's a break. Let me make sure I said that right. Dollar sitting still, pound dollar going up, euro dollar going down. Yeah, that's going to be a euro pound short. If the dollar index is consolidating, that means that your crosses without the dollar in them, closely correlated pairs, are going to be paired together, like to make a cross like euro pound. That will make them go up, and the dollar will just sit still. So, you know, in reality, Forex is a lot more complicated to teach than index futures. And index futures is a better market to trade because everybody has the same price. You don't get the same tomfoolery with brokers where they can give you a different high, a different low. The spread can widen and take your stop, but everybody else's broker firm didn't get that same price. So you're asking to lose money there. Like you're asking to lose money. So in futures, it's a lot more level playing field. And even though there are some things like we have here today, you're learning the very things that prevents me from showing you these enormous lists of losing trades because I can recognize these things. And it's the logic that repeats in the lectures I've already given out in the core content lessons on this YouTube channel. If you know how you're going to lose money, if you can recognize the conditions that's going to be more difficult than it should be, doesn't it make sense for you not to take trades yet and wait for that movement in your favor where it's obvious? So where it's at right now, that volume imbalance, that should be the end of it. If it's going to go up there, it should be done here and it should start to move up. If not, it's going to break below here, and then we'll start seeing the NASDAQ move in sympathy with that of the Dow. Look at the Dow. It's just staying down on its lows. So whenever you see this decoupling, every price run, whether you're trading the ES or if you're trading the NASDAQ, I guess for the folks that are just nuts and want to trade the 30-30, if you want to trade this in this index here, the Dow, look what it's doing. Would you want to trade this when the NASDAQ and the S&P are going up? So I'm kind of giving you the flipped perspective of it. Say you are predominantly a Dow trader. Would you want to be trading this indice if it's doing this against the two higher composite indices, which is the NASDAQ, which uses 100 stocks to make that composite index, And then you have the S&P 500, which uses 500 individual stocks to make up its composite. So if both of those are going higher and this one's going down lower, what does that mean for you as a Dow trader? It's still decoupled, right? So they should be moving in agreement and sympathy one another. They all three should be going up if they're bullish, and all three should be moving down when they're bearish. If there is ever a time when that is not true, like we see here this morning, that is a sit still and wait. You have plenty of time in the rest of the day. You have plenty of time. You still have the Powell speech later today, which is inviting this very event here, decoupling. A lot of people don't, there's not a lot of big money movement right now. They're just moving price around. After Powell's done talking, 15 minutes after that, you're going to see very nice, clean price action. But are you willing to wait for that? Most people aren't. Okay, and we overshot that volume imbalance by a little bit into the gap here. So, are you watching any other live streamers besides me? Are they complaining about the ugliness of the price action yet? I'm sitting here sipping some water, smiling, thinking, none of this is a surprise. I'm not surprised. Nate Diaz. I ain't surprised, motherfuckers. So, like I said, when it gets down to that volume imbalance, that should have been it. We should have started to rotate higher. If it's going to go up for that buy side, that was the time for it to do so. So far, it's indicating that it could, not that it will yet. I'm more interested in once we get there, once we get into this area here, does it hold? Does it stay there and go higher? Or does it go there, spend a little bit of time, which is reasonable, and then start to break down? Because that means that they went out there to accumulate those buy stops, and now they've unseated anyone that was profitably short, and any movement lower, they're on board with the targets and things I've outlined at the beginning of the pre-market analysis. So far, there's literally nothing in here that I would be long on. Not one thing. Not that there ain't setups there. There are. But there would not be any of them with my money behind it. And you'll get that, and you'll understand that when you can see setups that are on multiple time frames, multi-directional. You can be a buyer and seller in the same day. Just because you can see them there, just because you anticipate them panning out, just because you can frame a stop loss that's reasonable, if it goes against your analysis and you're waiting for your setup, why would you be impulsive and try to do something and prove that you're not patient, that you are impulsive? It goes against the entire grain of what makes a profitable, consistently profitable trader and the mindset that they hold. You have to have control over yourself. You have to have a discipline to stick to. If you've done the work in the analysis, then wait for the setup to come to you. And everything else that's going on outside of that should have absolutely no effect on you. You shouldn't be losing your mind over it. You shouldn't be panicked about it. You shouldn't be, I'm afraid it's going to go the other direction. What if it rallies 250 points? So what? It's Monday. 250 points is nothing. You literally have to stop making every next trade decision the pinnacle of your career. Because when you do that, you're actually creating the exit ramp for your career, or at least for that account. You're probably going to blow it because you're placing too much emphasis on having to do something. I'm watching the bodies in here in respect to this gap in here. Very, very, very content with being sidelined right now. The chop is real. Oh, he should make t-shirts, man. He could make money on that. He's be making somehow. Look at that. That gap I was telling you there. Boom. And let's go take a look at the Dow real quick. Pulling up into its gap right there. It's a little smooth, I guess, on the upside, isn't it? They might want to pop that with ES. But you can see how much more complicated. This is a complex market to trade in this morning because you have each indice doing its own thing. And it's real hard to frame low risk in that environment. You can see what it's likely to do, but is it worth putting your money behind it? Not for me. I mean, you're welcome to do what you want to do. Take your wins and go on social media and get your trophies and stuff. But yeah, not me. I'd rather sit here and prove that I have discipline over myself, that I'm going to stick to the tools that I trade and authored, and I'm going to let the setups come to me. And if it runs without me, it's okay. I'm good enough to know that I'm going to be able to find a setup in the afternoon. I'm good enough to know that I can trade that last hour and make whatever I need to make in a job in a month. I can make that in the last hour trading. That's the confidence, but that sounds like arrogance. It sounds like it's bullshit because you all that think that way can't do it. So you think nobody can. And that's not true. And if you just stop thinking critically like that and just try to learn, you can be able to do it too. And you'll think, wow, I used to troll you too, ICT, but now look at this. Good, welcome. All right, so we're inside the new week opening gap here. It's also consequent encroachment of the opening range gap. That's what that yellow box is. So in a perfect world, it would want to drive into this sell side here. This gap as it was trading up into that. I was telling you, watch that gap right there. And she was very, very useful there. It's very close to the high of that imbalance that's shaded in purple, or whatever shade that closest to purple is here. Now, in that yellow box, what can happen, and I would like to see happen, is for it to drop down, stay inside this red box, come back up and touch the bottom of the yellow box. And if it leaves that volume imbalance, come back up and reprice to that volume imbalance between this candle's here and here. Hit that and then rotate lower. But it may not do that. It may just take off rolling. Either way, it's fine. I told you I wanted to see it go to here, but I'd like to see it use the opening range gap low that this yellow box represents. I don't want to see it deliver like that, though. It needs to be a separate candle. In other words, if the candle would have been down here and stopped and created a new candle and trade up to it, any type of return back to a premium array, you want to see it do that. You don't want to look at it on the same candlestick where it moves away from the PD array and comes back to it. And that's never what you want to see. That's never, ever, ever a point of entry for you to use it like that. It needs to create a new candlestick and trade up into it. Then expect it to roll over. This is what you get by just reaching into these little lows here and back inside the opening range. So let's take a quick look at ES once more. This is the benefit of having multiple screens, by the way, or dividing your screen. But I want to keep one big chart on the screen as I talk. My eyes are a little bit fatigued when I'm done doing these live streams, when we're doing two screens and I'm squinting. I gotta protect my eyes. As much as I want to teach it, I still have to take care of my eyes. So imagine you're an ES trader. How you feeling right now? You feel confident? Are you confident about your short? Are you confident about your long? Are you confident that you made the right decision by sitting still? Are you regretting that you did anything yet? Or did you chop yourself up already? Because the market didn't chop you up. You chopped yourself up. would be grateful for that because I would have been looking for instances um, where I blew my accounts, where I hold on one second. Sorry about that. My wife just got back. The dogs are beating her. But as I was saying, I would want to see. I want to see someone explain when I was 20 years old how to avoid when the market's hard because I thought every day was a trading opportunity, and I didn't think that there'd be times where there's not all the advantages that should be afforded to a trader. Like I thought that I just didn't know enough, and everything that's going on in the price action was an opportunity for someone to take a trade on, and they could be profitable every day. That's the belief I had. And I found that I was losing a lot because I didn't understand these types of conditions where we have decoupling. Now think about what you've learned so far this year. And just in the last 8 weeks, you've learned how to identify high resistance liquidity profiles. You've learned about seek and destroy and how to anticipate them and see what it looks like real time to identify it. You've seen an episode here now with decoupling. And how do we anticipate decoupling? Whenever there's a Fed chair speech, FOMC, those types of things cause decoupling. Everything just unravels. And that's why you have to wait 15 minutes after he's done talking to allow for things to try to get back in sync. And they may not get in sync in the first 15 minutes after he's done talking, but you wait until they do. If you don't see that, you sit on your hands and you don't feel bad about it. You don't regret it. Yes. It gives you a peace of mind. I mean, look at the ES. That's oh, that would make me mad. if I was in that man, I'd be like, come on, what are you doing to me? And NASDAQ is rolling back down outside of the opening range gap. So same thing I was outlining here. I'd like to see it trade down in the lower portion of that pink box, create a new candle without leaving or going below this low here, create a new candlestick, come up and trade up into the low and or the lower quadrant of this yellow box. Because we went back up and did what? Traded back into the new week opening gap, repriced to the volume imbalance right in here between these two candles bodies and here. So the only market that's doing what we would want to see happen in price action is the NASDAQ. You see that? So the symmetry in the market as a whole is broken, but we are able to see price cleaner on this one than we can see it on the Dow and or the ES. That's just as good coming up. Didn't quite get to it. So by it not trading back to the opening range gap low, breaking down like this for the sell side, that's actually weak. That's good. You want to see that. But affording yourself the opportunity to do this very thing here, that's good. And see if we can rush down below these lows and accelerate, not just go below it and come back up into the opening range gap. We don't want to see that. Knowing when to sit still, that is an art that you all should master, because it's these days where you're going to lose money and you won't realize it until after the day. ends, and you look at it, and you're like, man, I wish I would have stopped trading right when I felt like it was getting too hard, or it was getting messy, or you all call it choppy. Now you're learning how to see it real time, so that way you can sit still and behave. Don't act like a fool and get out there and just try to do something because you have time to be in front of the charts. Exercising control over yourself, knowing what you're looking for. If it doesn't come to you, don't do anything. Don't anticipate the setup and enter before the setup is there. Anticipate the setup, and when it comes, then pounce on it. You're not reacting, you're anticipating it. But if the market's presenting opportunities that are far less likely because the symmetry is not there, that means all three indices are doing their independent thing. Well, that's never a market environment where you should be using high risk and or forcing, I got to get into a trade. You don't need to feel that way. Now, again, I don't want to see it just go below these relative equal lows. I don't want to see it go down there a little bit and then come right back up into this yellow box. That's not something I want to see. Oops. 4. Beautiful, isn't it? Beautiful. Looks like a thumb. Useless. There's that gap still in play. Let's see if they want to jump up there and get that little area there. Somewhat of a breaker. I'm telling you, you couldn't pay me extra to trade the Dow. It's just such an ugly index. I can't stand it. I've made money with it, but I've lost more money trading Dow than either of the three indices because of this. It just does some squirrely stuff that I just don't like it. All right, so NASDAQ should get some movement lower. So we're leaving those 3 highs up there in ES. So that bolsters the idea of if NASDAQ can get down to where we were outlining this morning, they might be onboarding longs there and then come up higher later on. Not necessarily today, but later on in the week it might be revisited. So not bad. The key takeaway, Caleb, so far is we were able to see that gap right there could be used. And we've been framing the idea that we want to see NASDAQ go down, not go up. So we've seen the market trade lower. We had a swing low in here that was pierced there. So you have a shift in market structure. Fair value gap trades up into it beautifully. We were calling the fair value gap before it traded up there. So I said, watch it. So you'll see it in the stream. You'll be able to rewind it. In fact, you probably still should be able to rewind it now, but you shouldn't be rewinding anything while I'm talking because you're going to lose some kind of information that I'm talking about live. But then we delivered nicely off of that. And then we traded down to half of the first presented fair value gap, which is this candlestick here. So in fairness, it looks like this. And again, this is why I don't draw everything on the chart that I'm referring to, because look how much is already on the chart. It makes it complicated if I do it this way, but I have to draw them so that way you can see what my eye is keyed up on. And I'm looking at it in this perspective, but I don't need it to be on the chart. And I'll show you what I mean by that. This candlestick's low, and the down close candle here's high. That is this shaded area here. Okay, so this, I just might as well tuck it in here too. If we're bearish, which was what we've been focusing on for NASDAQ today, we're not interested in being a buyer. It can go up and not have any interest for us. I'm not interested in it. I want to see the sell-off. I want to see the short side of it. So if the first presented fair value gap here at 931, which is the earliest it can form based on what I'm giving Caleb as a model, if I'm bearish, and this is the fair value gap that we're going to focus on, how would this candlestick be used? As an inversion fair value gap. Now, I'm saying it slowly and carefully because I want to make sure that I correct myself because I did something incorrect last week in stream. I said something incorrectly, and then because I heard myself say it and I was live streaming, I kept going back to calling it the same thing incorrectly. And it was based on me drawing on the chart, and it disorients me. So when you're bearish on the market, up close candles that make a fair value gap, which is a buy side imbalance, sell side inefficiency, is going to be a bearish inversion fair value gap. So if we go down like we do here, we went to consequent encroachment of that gap, which let me shade it with the little horizontal thingamajiggy in here. Make it bold. So we've been bearish. The market used the fair value gap I outlined before it went into it, trades lower, trades down into and away from, see the orange shaded area here, this box. We left it, came back up, went right to consequent encroachment to the tick, right to the tick. Then it behaves as an inversion fair value gap, lower. If at any time after it delivers on the basis like it's done here, it's reacted and left it and took out a low, that is already done enough to afford it as a properly classified inversion fair value gap. It does not need to trade down the sell side here. It does not need to go down to the target I outlined today. It offered a trade to take out the sell side that would be resting right below that low here. From consequent encroachment to that low, that's a setup. If we ever trade back above and back into this fair value gap and come back down into it, this would be classified as a reclaimed bullish fair value gap because it's an up close candle. That's how you classify it. I made the mistake of calling it an inversion fair value gap last week when it wasn't so. It should have been called a reclaimed bullish fair value gap. So I made a mistake last week in my stream. And it's because I got disoriented by drawing on the chart. I know what I'm looking for. If you go back and listen to what I was describing, you'll hear me describing what I see price do with that range. And I just mislabeled it by the name. But what I was expecting to see price do around it is what was accurate. But I did make a mistake and call it inversion fair value gap when it should have been reclaimed fair value gap. So again, even in a sloppy, disjointed, decoupled market where the ES is doing this and the Dow is doing that, our market, we did pre-market analysis on, and all the PD arrays are delivering. Fair value gap, I told you we were going to consolidate around up in here. Perfect. I told you retail's going to want it to go higher. Well, what am I doing? I'm arm wrestling retail with smart money concepts. Smart money traders are shorting up here, accumulating those positions. Then we have a displacement lower at the fair value gap. We were down here. I told you, watch this fair value gap here. Trades up into it perfectly, drops down, first fair value gap here. It's a buy side imbalance, sell side efficiency when we're bearish, meaning what? It's going to be used as an inversion fair value gap. Once it trades out of it, comes back up, consequent encroachment. You want to see the lower half be used for entries, and once we leave it, the upper half stay untouched. And that's exactly what you're seeing here. And then our markets trade down into sell side liquidity there. So now we take this and we couple it with this low. And we dim this one. It's on your chart still, Caleb. It'll be in the chart, but just I'm not trying to draw too much emphasis on it now. It's just for you to be able to have it in your notes by screenshotting it. Only today's stuff, son. Tomorrow you're gonna have to do your own charts. Okay, so we want to see this expand down. We don't want to see it come back up into this inefficiency up here. It's in this box shaded area. Opening range gap. We're going to take that out for now. You can see the inversion fair value gap there. And we want to see speed here. Aggressively run down and take that sell side. We don't want to see them be able to pull their orders. You don't need level 2 data for that stuff. You don't need bookmap. You don't need anything else. You just got to just look at where's price. If you were long from anywhere in here, or you went long up here, but your stop loss is below here, how confident would you be that you're in a good position to still be in the trade, or that you think this is still a bullish market? these are all questions that I think about when I'm watching price when it starts to move towards an old low or an old high. I try to put myself in a position of who was in this trade right now, who was getting long, or maybe would have regretted being long, and maybe they might look this and say, hey, this is a good time to buy now. I missed this opportunity, but now they're presenting this. So is that something that they would be willing to buy into that? I don't know. Yes. Every single time it moves. Okay, Dow. We're almost in that fair value gap. This one's so dirty, it's probably going to want to unsettle these highs up here. So that's more like where I would expect them to take the Dow, because Dow just broke lower rate from the opening. Challenging market today for folks out there that aren't looking at the things I'm teaching you. That's an invitation to show me your trades, by the way, for the folks that like to troll me. Show me your Elliott wave today. show me your knickknacks, your paddywhacks. Give a dog a bone. NQT2024. What are characteristics of high resistance liquidity run profiles? Deeper retracements than you want to see. Targets get traded to later than you want to see them traded to. Smaller inefficiency there. 3 up close candles. Changing state of deliveries, that opening price there. That would be like the last line in the sand for me. I wouldn't want to have anything else go higher than that. Like I said, I don't want to see them come back to that first presented fair value gap. To do that is problematic for being short in the first hour trading. And we are basically technically ending that in 15 seconds. So time together. So in quick summary, I'll try to do this in 1 minute. We looked at how the market presented reasons why I believe that we still could very well be down here. I think that will still be a factor for this week. They left this sell side in place. They went back inside of the new week opening gap, which are these 2 purple dashed lines in here. And we're back inside of the first presented fair value gap. Caleb, you would not use this as your short. Here, yes. There again, no. What is it doing? It's returning back to your point of interest. If it's going back there twice, it's not as good as you want it to be. And you want it to react the first time you get into it and then displace lower. It did go to our sell side. It got close to the next one here, but then said, no, I'm not going there, and started pulling back up. And I told you I did not want to see it return back to the first presented fair value gap. I didn't want to see it go back to the low of this imbalance here. So because it was going to go here, it's going to go back to the first presented fair value gap, and or inside what? New week opening gap. So if it's going back there, that's fine. It's going to do so without you. So your trade would be entering here at consequent encroachment of your first presented fair value gap. That's going to be inversion. Also keying up on the new week opening gap laying over top of that, and your target would be these relative equal lows. You take a large portion off. If you were inclined to have more than one, you don't have more than one contract now, but in your notes, you're going to say this would be first partial or majority of your trade-off. Why? Because you're in a decoupled market. And then your next target would be here, which did not pan out, so you'd be stopped out going back into the first percent of fair value gap. So you're only going to be able to annotate with the basis of this being your profit taken, and you watched as much as this deliver, but that next level didn't give it to you. And it went back to what you heard Dad say, I don't want to see it come back and touch this inefficiencies low here or the first percent of fair value gap again. I don't want to see that. To do that doesn't afford you enough time to trade in that first 1 hour trading. So you have to stick to the rules. Even if this does roll over, you have to have rules, son. You have to have a basis to stick within and say, this is the guidelines I'm staying inside of. If I stay inside these guidelines, you've already seen enough to know that we have rules that tell us when we can avoid very difficult market conditions. And by having that, we are already ahead of everybody else out there. We already are light years ahead of everybody else out there. Everybody else is out there trying to push the button. You're going to wait when it's easy. And you can see it with the rules I'm teaching that it's easy. If it's complicated, if it fits any of the criteria that I've taught you so far about seek and destroy, market is in high resistance, liquidity run profile, and now we have decoupling today. So you can recognize the adversities, so that way you have much more experience by understanding these profiles and how the market's booking price than if you just would have spent 10 years of retail stuff, because retail won't teach you this stuff. It ain't going to teach you this. No one's teaching this kind of stuff. They're teaching you how to get into trades. I'm teaching you how to avoid when trading in these conditions are less likely to pan out in your favor. That's the key takeaway today, okay? So for everyone else listening, I hope that you found something insightful in this. I hope you learned something of value. We will be back at it again tomorrow. I believe that we will be, I'll probably be doing a 7 o'clock start time tomorrow. And I think that might be the rest of the week's schedule as well. I promise this is the only week that we're going to do it like that, but I want to teach pre-market more in depth. But today, I'm satisfied with what I taught. I'm satisfied with how the market has delivered. And I believe that if anyone has a serious mindset about learning, there's huge value in what was shown today, because I could have used this and spared myself dozens of blown accounts in the 90s. I would have literally kept myself out of the very instances where I hurt myself and lost the entire account. It was in these days. I would look at the market, I would see that these things were occurring, but I never saw it as valuable information or intel. I just look at it as, okay, well, I'm in the right market. I'm in the index or the commodity or the currency future that I took a trade on. So I have to stick with it. I know I have all these other things that's scaring me right now, but I'm not going to identify that as a reason to get out, just be content with whatever I have. I held on to it and I arm wrestled the market, and it took it from me. It took the profit I had unrealized, and it took the entire account. I'd be impressed if you go through the same kind of pain that I went through. That's not what this is about. It's for you to do it better than me, to do it faster than it took me to do it, because I wrestled through all this stuff. You're getting blessed. I feel like the Lord's laying these things out perfectly, so that way you get these lessons in the beginning. And that way you can have this understanding right from Jump Street and have it in your mind, knowing that there are days when I don't have to trade. And it could still move around with a rhyme and reason that I can still see. That doesn't mean I need to go in there and risk real money. And then when you don't have these types of conditions, because there really isn't anything else now. There is no other reason to stay out of the marketplace. We've already covered all three bases. High resistance liquidity profiles. They're tradable, but you have to handle them differently with a wider stop and hold on to that stop near your entry. Seek and destroy, you can't trade it. And then decoupled markets. You can trade them, but you're probably not going to get your targets. You're going to have similar things like a high resistance liquidity run profile where it's a lot of give and take, but it'll eventually get to where you want it to go. But are you going to be good enough to pick the NASDAQ over the ES? I don't think you will. So to keep that from ever being an issue, I told you to stay with just the NASDAQ. So I'm filtering all of these scenarios because I've taught lots of people all around the world. And for 25 years I've been teaching. I have picked up on how they make the same mistakes. So by forcing you to just use one instrument, it removes the tendency or the opportunity for you to be tricked by feeling like you picked the right one, so therefore stay with your trade. No, you have to look at all three averages. And if they don't agree, if they're not moving the same way, they're decoupled. If they're decoupled, you're not going to get a perfect price run like you would want in a low resistance liquidity run profile. We don't have that here, but because you've seen all three of the things that cause difficult trading, not impossible trading, difficult trading, anything that doesn't fit the criteria that you've seen in those three different profiles is easy trading. They run right to your targets. Your entries are perfect and pristine. Your stops are easy to place and low risk. And it's just pleasant to trade in those environments. And if I can teach you to focus on that, and anyone else that's listening, if you learn to identify those conditions when it's low resistance liquidity run profiles, your trading will be enjoyable. It will not be stressful. It'll seem like it's effortless. And while there's still inherent risks with that, and you'll still get stopped out once in a while, you're going to find that the market quickly wants to go to where you think it's going to go and where your targets are resting. That's fun. That is what encourages continuous adherence to good sound money management and logic behind the trade setups. So with that, wish you all a very good, pleasant day. And I will touch base with you, I'm sure, with some kind of review video. And until then, Lord willing, I'll see you tomorrow. Be safe.
It takes more than a big idea to change the world. It takes meaningful action